Good morning, good afternoon, good evening, and welcome to ADGM's first webinar of this year. I hope you had a good break and you and your family are safe and sound. So as usual, we are starting this particular series with a webinar and session on digital banking. And we have a fireside chat with my colleague Fraser Brown, and then followed with a panel discussion which will go wider and deeper into this area of digital banking. So let me introduce Fraser to you. Fraser?
Hi everyone, thank you for joining. It's a pleasure to be here. I'm Fraser Brown. I'm the Executive Director of Banking and Insurance at the Financial Services Regulatory Authority in ADGM. Bhaskar, back to you.
Thank you, Fraser. So the first part of this session is, as I said, a fireside chat, where I'll have a nice, relaxing chat with Fraser on all things digital banking. So, Fraser, let's take a bit of a step back. I mean, you have been around quite a lot of jurisdictions. You have worked with quite a lot of regulators. You have significant experience with banks. And I would say, in my experience, you are one of the very few regulators with such a wide array of different jurisdictions and firms. Would you be able to shed some more light on your background and what you have seen in terms of regulation in your experience, please?
Sure. Thanks, Bhaskar. I'd love to say there was some sort of grand plan in all of this. But I can assure you there really wasn't. After a couple of false starts in my career, I found myself working for a small brokerage firm concentrating on the London Metal Exchange, doing a little bit of FX trading and managing a small fund. Compliance really was in its infancy back then. This is the early 90s. And despite being in compliance, I was even executing client orders, something that would be absolutely horrific by today's standards, but this predated even Nick Leeson. From there, I joined the Securities and Futures Authority, which was soon absorbed into the Financial Services Authority, with the great coming together of 1997. And my focus there was again derivatives firms, overseeing a few banks, but also looking chiefly at the oil market and what was then the International Petroleum Exchange. So my background isn't really banking as such, but I've supervised and authorized banks as a regulator, and I've worked both sides of the commercial regulatory divide. I've been in the region for 21 years, and for the last 16 of those, I've worked in authorization roles at the DFSA and the QFC RA before coming to ADGM at the end of 2015, not long after it went live. And during that time, I've sort of covered the full spectrum of activities really and financial sectors.
Great. It does sound like a fascinating round robin, so to say, with different perspectives. I know it's difficult to summarize, but let me ask a different question. If I were to ask you to summarize, say, for example, 2 or 3 lessons that you learned when it came to banking regulations and regulating banks, what are the 3 things that you would bring out for our audience?
It's probably a lot more than 3, but for me, fundamentally, regulation is about balance. And I've seen the pendulum swing back and forth between light and heavy touch, even over the course of the last 16 years in the region. It's great to have to be risk averse, but if you're too risk averse, no one's going to be doing any business, and there's not really much point in in me being here as a regulator. So you need to strike that balance. I think simplicity and clarity are always optimal. And I think the FSRA's prudential rules on banking hit the right note in that respect. But I also think it's important not to lose sight of conduct of business matters. A lot of focus is put on prudential aspects of risk management, and the financial crisis of 12 years ago is quite often sort of laid at the door of prudential oversight. But I think a lot of it was to do with conduct of business, firms not being run properly, banks not being run properly, a misalignment of risk appetite and risk responsibility. So you mustn't lose sight of issues such as governance and internal controls. And increasingly, operational risk is coming more and more to the fore. And that's one of the key areas of additional focus when it comes to digital banks, I think. In terms of authorizing banks, and I'll probably come back to this later on, it's important that applicants recognize the significance of what they're undertaking in making such an application. And that's particularly for startup entities, but equally true for existing concerns moving into a new jurisdiction. If you are a startup, it often doesn't hurt to start small and sort of build outwards and upwards, while establishing a regulatory track record and a brand name and a customer base.
Great, thank you very much. I see from the comments that we are having people from Singapore, Africa, India, Europe, etc., etc. So I think pretty much a good international audience. And if I go back into history, I mean, banking obviously has been using technology for a long time. I guess going back to the 50s, although that might be showing my age, we've been using technology for credit card scoring, retail operations, etc., etc. But now, digital banking has come up as perhaps a new thing. What are your thoughts? I mean, why is suddenly digital banking as a term becoming so popular, despite banks being perhaps the early adopters of technology for a very long period of time?
Yeah, you're right, Bhaskar. I think banks have always been, ready, willing, and able to innovate and adopt more efficient ways of doing things. And of course, people always point to the introduction of ATMs in the 60s and early 70s. I think what's changed over the last sort of 20, 25 years is really the exponential and continuous development of IT. It's like it's, for me, taken something of a leap forward. And I think that's allowed significant disruptors to enter the market. The likes of PayPal in the late 1990s is a significant name. But in a sense, these guys have sort of democratized banking, if you like. They've almost given it a chance to realign it to a fundamental social function that banking provides. And we've arguably lost sight of that in maybe the earlier phase of technology, where maybe customers have been reduced to no more than a number on a screen. Digital technology has the ability to put the customer at the core of the process, prioritize their needs, and provide a holistic experience that goes beyond just merely banking itself and becomes more of a kind of lifestyle interactive platform, if you like. I think what we'll see in the near future as well is existing banks starting to work more closely with fintech providers, and rather aligning themselves with them rather than as competitors. And I think the ADGM provides an ideal environment for that, with work progressing on API and open banking initiatives.
Great. So if I can just focus on what you were talking about in terms of the FSRA and the digital banking side, would you walk us through the history of digital banking regulation? I see a comment from one of our participants, Simona. Thank you very much for that. The operational risk that is coming in. Would you be able to walk us through the history of digital banking regulations that you have led over the past couple of years or so?
Sure, I'm happy to. Starting from the point of view that innovation and fintech really have been at the core of ADGM's philosophy, almost from inception, really. And we felt that the ADGM offered a jurisdiction where digital banks could provide a real advance in customer experience, particularly in certain sectors that are perhaps ripe for disruption, such as trade finance, where that relies on somewhat antiquated documentary processes, and SME lending, another key area where traditionally underserved, where digital bank platforms could typically deploy algorithms to allow them to make decisions much more quickly and with a more focused risk appetite. So building on the existing banking regime that was in place, the existing regulations, we developed an authorization guide specifically related to digital banking, highlighting some of the additional areas for particular focus, such as operational risk, as we've said, IT risks, cyber security, but while also continuing to emphasize the fundamental conditions for authorization and governance matters and the human element. Whenever I present on the authorization process, I always emphasize that human element, which is so incredibly important. Given we're sort of 2 years into our digital banking focus, we've authorized one digital bank in the trade finance space. We've got another digital bank that is under in principle approval at the moment, and we're talking to several more. We'll soon be releasing enhanced authorization guidance that sort of further focuses on some of those key areas that differentiate digital banks from their more traditional bricks and mortar counterparts.
Great, thank you very much, which leads me perfectly to the last question. You and I have spoken to quite a lot of digital banking aspirants and prospects who are interested to establish a digital banking presence in ADGM. What would you, as the banking authorizer, and of course you also have supervision responsibilities, could you give us sort of 2-3 big points that you would give to these prospects who are currently listening to you speak, in terms of the regulatory business plan, or how do you evaluate these prospects?
I think there's a lot of different elements in it. It's difficult to pick out 3, but I would say, and I touched on it earlier, really do think about the significant undertaking that it is to make an application to establish a digital bank. Again, whether that's a startup or an existing player moving into a new jurisdiction, and really underpinning it all is a clear rationale and a sustainable and viable business plan that's been appropriately researched, and evidences a real reason why the bank should be able to come here and succeed. What's going to make it work in terms of this jurisdiction? Think about what makes it a digital bank as well. Is it truly innovative, or is it just sort of moving existing policies and processes onto an online platform, and that might not provide the optimal experience for customers? And think beyond just the customer experience. Think as well about the back end. What's what's under the hood, if you like. What's going to the governance, the internal controls, the back office. How are customer deposits and funds protected? What are the arrangements around that? Definitely explain in real detail how the IT systems are going to be embedded. What's it going to look like in terms of the overall IT structure? Are you going to develop it internally, or are you going to rely on third-party providers and partner with them? I always say this as well: take a really realistic view of likely revenue and costs. Bear in mind, revenue is likely to flow more slowly than you might wish, and in smaller volumes than you might wish, while costs continue to mount day by day, as particularly in the early years, when and think about the fact that a bank is, it's a long-term play. Your investors need to understand that. It may not turn a profit for 3 years if you're lucky, could well be 5 or more. So those are some of the key areas, I think, and again, that human element. Employ people with appropriate experience, have in place plans for retention and succession. Think about the board from a holistic experience point of view, and the balance of executive and non-executive. But again, it comes back to that regulatory business plan. Does it make sense?
Great. Thank you very much, Fraser. I know this was a very short conversation, and we did canter through some of the topics, but I think those are very, very valuable points. A couple of points that were raised on the comments were around the new API proposals in terms of the third-party financial technology consultation paper. We'll be touching a bit more on the APIs in the panel discussion. And also another comment that came up is around use of technology such as blockchain as an enabler to trade finance. Again, we'll pick it up in the panel discussion. So again, thank you very much, Fraser. Much appreciated. And if I may on to my colleague to start the panel discussion. So let me introduce Cover to here. So Cover, over to you, please.
Thank you, Bhaskar. Hello, everyone. My name is Khabar Khalik, and I am the head of product at Anglo Gulf Trade Bank in the ADGM.
Hello, everyone. My name is Marianne Shikluna. I'm the Senior Executive Director of Banking and Insurance within FSRA ADGM. I have a background in regulation and been in regulation for 25 years. And primarily, I come from a European background. I hand over to Paul.
Hi, everyone. My name is Paul Kairouz. I lead the FinTech, Blockchain, and Emerging Technologies Practice Group here at PwC Legal, based in Dubai. Very happy to be here to be talking about digital banking. Over to Ronit.
Great. Thanks for having me on today. My name is Ronit. I run FinTech and Banks research for Citi out of Dubai, also run our Middle East research effort. Over to Sean.
Thank you, Ronit, and welcome everybody. Thank you for having me on this panel. My name is Sean Edwards. I'm chair of the International Trade and Forfeiting Association, which many of you are probably members of, a global association of around 250 members, a lot of members in the Middle East, but also Europe, North America. My day job is as head of legal at Sumitomo Mitsui Banking Corporation, one of the Japanese mega banks with a lot of operations in the Middle East. And Bhaskar, hand back to you.
Great. Thank you very much, and welcome to the panel. Now, as you can see, the panel is really heavyweight. We're talking about senior regulators, senior legal people, heads of industry associations, It's a product management for AGTB, one of the first purely digital trade finance banks. Paul, who has a brain the size of a planet, and he knows everything about new technologies. And then my friend Ronit. People who are in fintech would know him. So, literally, I have a very, very challenging task trying to keep such an interesting panel talking about so many interesting things. But let's crack on. So, obviously, 2020 was a rather interesting year, especially when it comes to digital banking. The macroeconomics has really changed. So let's try and get a perspective from each of our panelists as to what did they see, what changed in digital banking last year. So if I may start with you, Marianne.
Yes, of course. Happy to take the question. Well, obviously, I'll answer from a regulatory perspective. And in 2020, we've obviously COVID accelerated the need for online services. And we've seen a mix of entities automating existing processes, but also we've seen a number of innovative proposals being put to us, catering for the changing needs and demands of consumers for digital services. And we've seen an increased demand also from consumers for more relevant and specific services that are specific more to cater for their needs. I think 2020 made customers see banking more as a commodity and consumers looking for more relevant services for their day-to-day needs. And that has been reflected in the kind of proposals that are coming our way at FSRA ADGM. Obviously, that has brought to the fore certain risks from a regulatory perspective that we need to be on the lookout in delivering on our regulatory objectives. And primarily, cybersecurity has been on the fore, as mentioned by my colleague Fraser. Data management is an area where we're seeing new risks emerging as due to the fact of artificial intelligence and machine learning being included in the innovative proposals that are coming our way. Challenges with digital onboarding of consumers, management of third-party risks due to the various interrelationships and the different outsourcing models that we are seeing, and the governance of the whole system. Obviously is a key area that is bringing up certain challenges. And last but not least, also the profitability of these innovative proposals and the sustainability of these proposals going forward, because it's easy to put a proposal together, but obviously from a regulatory perspective, we need to look at this from a sustainable aspect.
Great, that was very useful. Thank you, Marianne. Sean, if I may ask you to comment on that, obviously you are wearing two hats on. I mean, one is obviously the chair of ITFA, as well as from SMBC. But if you can give us your thoughts as to what you have seen from your association and from your personal experience as to what did 2020 bring to the table?
Sure. Well, I mean, let me start first of all with a bigger picture about what's happened amongst the members of the association. So as ITFA, we have around 250 members, and that's a mixture of banks and a lot of fintechs. We have about 35 fintechs that represent really the good offering in the trade finance area. So our fintechs really cover the A to Z of trade finance, from funding, infrastructure, software, and so on, technology providers. And I think just looking at the big sort of macro picture, what's interesting is 2020, when we started to go into lockdown, we didn't see a big bank crisis, all right? This wasn't the GFC of 2008-9. And bank liquidity was assured by so far as trade finance is concerned, by the efforts that the US Fed made with their swap lines to ensure dollar liquidity around the world. So we didn't really have a liquidity problem. We didn't have a bank solvency problem. But what we did have was cutting back of lines, banks acting naturally very cautiously. And I think there was a big hope that the fintechs would step into that area and would sort of step into the vacuum and provide the funding that was not being made available by the bigger banks or the medium-sized banks. That actually didn't really happen. The fintechs weren't able to step up, and I think that points to a fundamental point around what fintechs are. And I still remember, 5 years ago, when people were very, very worried that fintechs were going to take over banking and banks were going to disappear, and that hasn't proved to be the case, at least in trade finance. There are niche areas where actually some fintechs are doing a better job, in my opinion, than banks. But generally speaking, that hasn't happened. And the reason is quite simple. They don't have the funding, the liquidity, the capital themselves. So they have to rely on banks. So without the banks, there wasn't very much that they could do. But the other phenomenon that we found, of course, is that banks are becoming, as I'm sure all my panelists would agree, banks are becoming more digital, more digitized. And 2020 did accelerate that. There are a number of issues that we can talk about. Wearing my legal hat, certainly I'd spend a lot of time pushing the legal agenda on digitization. The technology really is there for most of the things that we need to do, but getting that final hurdle, I think people often put lawyers right to the end and think it'll all solve itself. Actually, it needs quite a lot of work because some of the solutions are private. And some of these have existed for a long time. For example, electronic bills of lading, because they're not recognised by most jurisdictions as having validity in their own right. There are private contractual workarounds that have been in existence for many years, and that sort of approach is being expanded to the wider digital area. But there's only so far that you can go with that. And so the other big thing that has happened is that there has been a lot of movement in governments and authorities such as yourself. And here I take my hat off to ADGM for being very nimble and acting very quickly. And it's been a pleasure to work with you on your new rules that have been based on the UNCITRAL rules for transferable records. But so there are people who are moving faster. Singapore, which is a very important regional player, is moving to adopt similar rules to you and ADGM. The UK government is a little bit more behind. We're mired a little bit in centuries of case law and precedent, but the Law Commission, and we've been helping them, is working very hard to try and reform the law. But that will take a little time. So what we've had is certainly banks still being the go-to funders for trade. There's been a cutback in that. The fintechs, as I say, haven't really been able to take that up, except in very niche areas. But we're getting a lot of good movement towards the change, and we'll talk about later what's going to happen. I think at least this year. Thanks, Pascal.
Thank you very much, Sean. I mean, I think that perspective from your association is vital, especially you bring in so many perspectives to the panel. Let me ask Kavar. Kavar, interesting year for you last year?
Yeah, it's been very interesting for us, Bhaskar. So I think the main difference from previous years that we noticed ourselves was that actually the customers are now asking for digital banking. Earlier, it was banks pushing online platforms, what have you, on the customers mainly. But I think last year, given the disruption caused especially by COVID, and when physical delivery, documents not getting through, things not happening on time, and shipments getting blocked, so the clients actually started asking for digital banking. I think that's the main difference now, where it's no longer banks driving the agenda, but actually clients saying, unless you can do this for me, I'll go elsewhere. That's one change. The second, I would say, is the confluence of the physical and the financial supply chains. Now, if you go back in trade historically, the last 20, 30, 40 years, there's a large part of trade which banks don't get involved in. Your freight forwarding, your logistics, your warehousing, insurance, inspection. So that's not what banks do or have done in the past. And the client is really left on their own, and they have to go back and forth between the banks and the shipping company and the insurance company and whatever, and they have to go with documents in hand to each party. So that's something that has now started to change, where especially given the blockchain technology, it's now possible to have all those stakeholders on the same technology and on the same architecture, where documents can be shared, smart contracts can be embedded into the blockchain, and you can really have a seamless chain of events happening where everything happens on the same technology platform rather than documents going back and forth. The third point I want to mention is historically we've seen the technical and digital part coming only to the front end, where banks built fancy front ends and that was the end of it. I think what's happened last year, especially also on the back of COVID, has been the digitization of the risk function, the compliance function, and other control functions. So banks now realize that it's not just enough to build a front end, but also to make sure that we need to use technology in a more smart way in digitizing and in making more efficient and more responsive the back-end functions, especially the risk and compliance functions. So that's where I think we've seen the big change in the last year. Thank you.
Great. Thank you very much, Kaur. I think those points about technology were very important. So let me bring in Paul now, because I think he's going to be able to provide some rather interesting thoughts on that. So Paul, what did you see from your perspective in 2020, please?
Yeah, so I think it's a very good question. I think from our side, we've seen a number of significant developments in the market last year. Probably the most important is the entrance of the big tech and the big tech firms into the financial service space and into banking in particular. So if you look at, for example, some of the really big names, Google, Amazon, Facebook, they're all looking into getting banking in a way or another. But what was about a surprise to everybody is that they don't want to become banks. They don't want to become regulated as banks, but they're partnering now with banks. So they're relying on the underlying banking infrastructure, and we're seeing some really big partnership agreements being put in place between these big tech companies and some of the big banks globally to provide a different customer experience. So this is something that we've seen last year. I think it is yet to take off. We're going to see more and more of these big projects going live this year and even next year. So this is one. The second thing is the banks. So the banks are changing a little bit their business model. Again, there are different strategies. Each bank has its own strategy. But what we're seeing now is banks are moving a little bit from focusing on product to building more a marketplace. So building a platform. So if you ask me what's the word that probably we heard almost every single day last year, it's platform. Everybody wants to build a platform, digital platform. So banks want to build digital platforms, fintechs wants to build digital platforms, tech companies, social media platforms, they want to build platforms, digital platforms. And so what some of the banks are doing in this space is they are trying to now be a bit creative in building new platforms where they provide other products and services which are already provided by different service providers. So they incorporate these products into one single platform to provide a more personalized and a more customized experience to their customers. And this is, I think, a really significant change that, again, is yet to take off. But we've started seeing this in 2020.
That is very Ronit, your thoughts, please. I think you have spoken about this for many months and with a variety of participants. And from your perspective of obviously multiple hats, but banks, research, fintech, and where you are based, obviously in the UAE, would love to see would love to hear what you thought about has happened last year.
Sure, and thanks again for having me on, Bhaskar. I'll focus first on fintechs, and then we'll talk about banks and big techs. So when you look back on fintechs, particularly what we call neobanks, whether it's in the UK, elsewhere, the neobanks were really successful pre-pandemic in client numbers. So if you went back to 2018, 2019, they were very successful in onboarding millions of clients. And they did that because they had better user experience. They were digitally native, mobile first, often built directly on the cloud. So they were very good at onboarding clients. What COVID really highlighted was that some of the neobanks and fintechs then became very good at also generating revenues and broadening products, while others didn't. So it was like a real sheep versus goat moment last year, when many previously unprofitable neobanks actually broke even by the end of the year. And those that did, their secret was that they managed to broaden their product range. They got into lending successfully. They got into investing, whether it was stocks or crypto. They broadened their product range. Others struggled. Others are still unprofitable, in some cases significantly unprofitable, and they haven't converted that client interface, a really snazzy user experience, into a product range. Ultimately, you're either lending, providing savings, or payments, if I'm simplifying. You can use all kinds of technology, but if you're not doing something in those families, it's really hard to make money. You can't make money on advertising as a fintech usually. So so there's a real kind of interesting moment last year where a lot of fintechs actually disproved the skepticism amongst traditional bankers that they can make money. Now, when it comes to big techs and banks, so as Paul said, the partnership model and the platform model is really the emerging dominant one. Now, there are one or two big techs, be it in the East Coast of China previously, and maybe still on the West Coast of the US, that want to have it all. But most, and a really good example would be Google. Google wants to partner, and they're doing it in the US. We're one of the banks they're doing it with. There are others, even emerging fintechs. So not emerging, they're quite big, like a Stripe, for example. Even a Stripe when they launched Stripe Treasury, was happy to partner both in the US and internationally. So that partnership model really seems to be the emerging paradigm. Facebook, if I had to call out one of the big techs who've tried to go it along, in some ways go it alone, particularly with their original Libra project, which has obviously been modified, they're probably further along the spectrum of saying, I want to do everything. So it's been a really interesting year.
Let me stay with you, Ronit, and ask you as to what do you see this year and possibly even next year. Now, yeah, 2020 come across as a wet fish across your face. And by the way, great comment about separating the sheep from the goats. I'm going to use it. But now, people have had 9 months or so of COVID. They have seen the lessons learned from a lot of the early adopters that you mentioned. And many more entrants are going to come in. People who perhaps didn't have a chance to get their budgets, they are going to start coming in. Do you foresee any changes in 2021, certain trends intensifying, or certain things that people tried out last year, now this time they're going to say, nah, I made my money, I'm taking off. What are your thoughts about what we can see in 2021?
Sure. Maybe I'll start with money and financing as the first point. Then we'll talk about product and type of products. So many of the neobanks, the independent ones, the fintechs and neobanks that launched in the UK or the US 6, 7, 8 years ago had a real hard time raising funding. In the US, typical West Coast VCs were consumer-focused VCs, consumer internet-focused VCs. They weren't naturally attuned to fintech. That's changed. In the UK and in continental Europe, there simply wasn't the local market. So when you talk to fintech founders who are successful now in London, San Francisco, New York, many of them will talk about how difficult funding was. It was the same in the region, in this part of the world, in the Middle East, until very recently. That switch has been flipped. And if anything, particularly in the US, maybe emerging elsewhere, but particularly in the US, there's a lot of capital. So the risk is actually there's going to be a huge amount of money chasing projects that don't materialize in terms of actually generating something useful for their end user client. And that's going to be a big risk, I think, in 21, 22, just because there's so much money now chasing this space. In terms of products, the sort of where a lot of new interests came in last year, and we could debate this, obviously investing, trading, whether it's day trading to long-term financial planning and robo-advisory in the middle, that became much more popular last year. And different ways of providing credit. I mean, we've talked in the past about BNPL, buy now, pay later, both amongst listed large companies like in Australia, most recently in the US, or amongst startups in this region, has become much more en vogue. And some of these models are untested. Many credit-driven balance sheet-driven fintechs, we've already seen in the US go through a cycle. Shares are down 90, 95%. It'll be interesting to see if this time is really different when it comes to credit-driven fintechs.
Great, thank you very much. We had a question from one of our audience members about the UAE and digital banking. And Paul, if I may bring you into this discussion now, based upon your thoughts and, of course, Ronit's comments about what we are seeing in 2021, investments into fintech and the wider ecosystem. And from your perspective, what would you see in 2021, 22 as trends intensifying, investments, banks starting to do more? Love to hear your thoughts.
I think again, it's a very good question. I think we're going to see some continuation to what we've seen in 2020, but in addition, we're going to see some new trends emerging this year, hopefully. So I guess the main headline on the corporate side is more around treasuries than corporate treasuries. Again, ADGM has a unique framework when it comes to setting up treasuries, whether for corporates or for banks, which allow, of course, companies and corporates and banks to manage their clients' money or their money in a better and, of course, a more efficient way. I think digitizing the treasury and using some cool technology like machine learning, and not only relying on historical data, but also trying to make some projections to the future, so that to allow your treasurers and the treasuries to have a more holistic view of their balance sheet. So this is the smart treasury, which every company or every corporate needs. So again, I think digital treasury is one key thing that we're going to see and more happening in this space. The second thing, I'd say open banking. We've seen open banking taken off in Australia, in the UK, in Italy, in the US. Also the US, it's driven by the market, not by the regulator. What we're seeing now in the Middle East is a number of central banks coming up with policies and also regulations around open banking, in particular around how do you share data, customer data, between banks and TPPs, the third-party providers, or the fintech. Now, this is very interesting because this will allow now banks to think in a more innovative way on how to, cross-sell their product, right? So, and it will also allow the fintechs to have access to data, which, they didn't have before. And then again, there's so much talking in the Middle East on open banking. We're doing so much work with various stakeholders, whether it's central banks, whether banks or fintechs. But again, I think this is a really exciting space, and I think there's going to be so much work in this space. This third thing is the different type of partnership which we just discussed. So again, if you look historically at some, for example, the partnership model between banks, techs, banks, and fintechs. So whether it's white labeling, outsourcing, I think now what we're going to see more work around API integration. The integration is really key here. So instead of building or structuring a traditional partnership model, I think both banks and fintech are becoming a bit more creative in the way they're working together. And I think this is something also that we're going to see more and more in 2021, 2020.
That was very useful. Thank you, Paul. Kavar, if I may bring you into the discussion now. Obviously, you heard from Ronit and Paul, and they were giving a bit of a macro view as to what they are seeing. You, as perhaps the region's first and global as well, the digital bank, In terms of your plans, and I know you can't speak too much about what you're thinking about, but would you be able to give us some thoughts about, in terms of going forward, 2021, 2022, what would be your focus areas, and where would you be looking to grow?
So I think as the panelists mentioned, Ronit and Paul mentioned, and even Fraser earlier, the focus now is going to be two, three things. So one is the end-to-end client experience. So you don't talk about anymore making a payment or looking at account balances. That's not what client wants. So what they want now is the end-to-end client experience, from onboarding through support, making sure it's reliable, making sure it's secure. So the one thing that is coming up is the end-to-end client experience. Now, how do you deliver that? So banks have been bad historically at technology. So they built or they bought these monolithic architectures. The technology is not very agile, not very easy to integrate with. So what is happening now, and what we see coming, is banks going to more composable architectures, which are more agile in terms of the way applications work together. They're more connected, so it's easier to use APIs to connect to third parties, connect to clients through open APIs. So the entire technology architecture is going to change, and has to change, and is now changing as we speak, to be able to deliver those client experiences, and also the automation required and the connectivity required with third parties to deliver that client experience. The third point, I think I just want to quickly mention what Fraser had mentioned earlier, is banks and fintechs are no longer thinking about each other as competition. So initially, banks were like, "Oh, they're taking our lunch. We don't want to, we want to crush them, whatever." That's no longer the case. And fintechs are no longer thinking about becoming banks. They're not banks. But I think there's a healthy competition, also a healthy collaboration now, in terms of fintechs and banks realizing they have their space, they have their strengths, and they have they do what they do. So going forward, there's going to be a healthy competition and healthy collaboration between fintechs and banks working together. So fintechs bring the latest technology, and the banks bring the capital and the expertise on risk management, and then to deliver to the client the ultimate experience that the client wants.
Okay, great. Thank you very much. Sean, from the perspective of the association, obviously a much broader population, what is the association and your members saying about what are they going to see in 2021, especially when it comes to digitization, trade finance? Where do you see that intensifying?
Sure. So, I mean, just focusing on trade finance, probably picking up couple of the points that especially Paul and Ronit made around partnership and investment. So, obviously, trade is a smaller subgroup of the digitization landscape, but it's a very important one. I think what is happening on the partnership point is that actually that banks and fintechs have been very, very collaborative. It's actually a great experience to work with everybody because you get, although there is competition, and eventually the products that are developed by the banks are going to be in competition with each other. There is, at least at this stage, a lot of cooperation, and there is too much to be done in too short a time for one bank or one organization to do it. So you need the help and the brain power and the funding of multiple partners, and that is what has happened, and that will continue to happen. The point about platform or platformization, to use the new coinage, that is something which is happening quite rapidly in trade finance for very good reasons. Trade is by its nature, global trade is interconnected. It is a network already, but it's divided up by a lot of silos, by distance, by different jurisdictions, different laws, different operating practices. So it makes a lot of sense to platformize what trade is doing. One of the big advantages of doing that is it brings together also, I think somebody made the point earlier on about, physical trade, ports, port operators, customs, and so on. One of the great hopes of platformization is that actually you can bring not just the banks, but the operators as well onto the same platform, or at least using standards that are interoperable. And that is beginning to happen. The interoperability, now there's this debate about whether you should go for sort of global standards or whether you should sort of have a fight to the death in the true capitalist sense, and you'll have a winner, which is the dominant platform that has obvious issues around competition. It's a bit of both at the moment. There are certainly big efforts being made, and there are standards that could be adopted. Haven't been yet. But I think the movement, because of the investment, the progress of the platforms is much faster. So there are a couple of dominant platforms coming into being, but even the biggest ones of those actually have a restricted agenda, because again, they can't do everything. They don't have unlimited funding, and they don't have unlimited human resource. So, but that is happening. What's interesting, and we'll see, maybe it's a trend that will start this year and it will go on for a couple of years, is actually consolidation amongst some of these operators, because there are some of these platforms that are, especially the blockchain ones, there are, because the technology is so powerful, there are actually a lot of very similar solutions to the same problem. So you've got, if you take letters of credit, you can have a pure sort of digital letter of credit, if you like, but you can replace letters of credit by payment commitments and payment undertakings. And that is a very legitimate approach to the issue of how you deal with the problems that letters of credit have solved for a long time. So there's a lot happening there. It will accelerate. As I said earlier on, lawyers are never popular, and so they always think of the law last. But there is a lot of change going on there. The UNCITRAL, for example, the United Nations Committee on International Trade Law, has some fantastic model laws that are now really beginning to see some take-up. They're the basis of your, Bhaskar, of your new ADGM rules, and quite rightly so, because by using those, I mean, not only have you acted very nimbly and have made a real difference in the region, but you've also interconnected with a global standard on this. And it's really important to, that we do operate according to similar rules or laws. So that's going to be a big, I think that's going to be an ongoing theme this year. The pace of change is not as fast as I would like to see it. There still isn't enough going in. I think one of the things which I should have mentioned earlier on, one of the actually phenomenon, for at least for me, for last year in relation to digitization, was how much people were and became happy with sort of workarounds. So ad hoc solutions, digital signatures, attaching your signature to an email rather than the document. People became very quickly very happy with these really improvised solutions, and so there are much better ways of doing this. We're beginning to really dig into those, and I think they are beginning to take hold. The other thing I mentioned is that, of course, there's a lot of stimulus packages that the major governments of the world are beginning to pump into COVID recovery, not without problems, of course. In the US, 1.9 trillion Biden stimulus package may be cut down and will have to go through Congress. The EU 750 billion stimulus package also has issues. In China, their 500 billion package it seems to be focused more on domestic consumption. But some of this, and there's a lot of interest in investors in the emerging markets, some of this will eventually flow into digitization, I think.
Great. Thank you very much, Sean. Marianne, if I may bring you in, you are in an unenviable position that you actually have to, as a regulator, oversee all of these things that are happening. As one of my old bosses used to say, you're going to keep an eye out on the cat and one eye on the fish. From a regulatory perspective, what are you seeing, as in what are your thoughts about what's going to happen in this year and perhaps next?
Yes, I mean, as all the other panel speakers have mentioned, digitization and partnership between banks and fintech entities will be the new trend, and is here to stay. So, and we as regulators, the way we look at it, also within ADGM, is that we have a very important role to play to facilitate that innovation and not stifle it with regulatory approaches. So it will be very important for us to continue to maintain that balance between delivering on our regulatory objectives, but also harnessing that innovation, which ultimately is beneficial for economic development and also to meet financial needs of consumers. So that will be continue to be a very important balance for us at ADGM. I think going forward, also regulatory sandboxes will increase in importance and the role those regulatory sandboxes will play. And in fact, at ADGM, we're continuing to develop the existing regulatory sandbox, and there will be further announcements later on during the year in this respect. And what is very important also is that we, on the regulatory side, as already mentioned, that we continue to develop our legal framework to be relevant to these developments and to this digital context. And also we ourselves equip our regulatory staff with this knowledge and to be able to speak the same language and understand these trends and also these business models that are being put forward for our approval and review. And one other important thing will be how we will continue to develop our supervisory approach and use more subtech and regtech technologies to adapt our approach to this new digital context and environment. Because ultimately, the role of the regulator is there to protect consumers, to ensure the soundness and the integrity of the financial system. Because without consumer trust, the system can be damaged. But at the same time, our role is there to deliver relevant regulation and supervision. So that continued engagement will be very relevant from our part with both the consumers and also the industry.
Great, thank you very much. I think it's good to hear, and yes, ADGM has got some rather interesting RegTech in place and plans to enhance that. I think we are coming towards the end, so if I may ask participants to give their final thoughts, and if they can, touch on one sector of the economy which did really struggle, and that is the SME sector, which unfortunately got hit by both supply and a demand shock. So maybe some quick final thoughts from each of the panelists, and if you can also address the SME point. So Sean, if I may start with you.
Sure. So, I mean, SMEs, I think, are a natural beneficiary of digitization because the point has been made for many years that it's very expensive to bank these small companies. But I think one of the other benefits of digitization actually is the way in which these stimulus programs can partner with or use digitization to actually target these SMEs much better. And we, for example, in ITFO, we've been speaking without success, I have to say, but we spoke last year to the UK government on the use of trade distribution platforms. So one of the things that will have to be done, and it's been, I think, HSBC have mentioned this in a recent report, is actually being able to support that debt and then find investors for it. So I already mentioned that there are a lot more interest in the emerging markets, but obviously SMEs are risky. If they can be underwritten or subsidized or guaranteed by governments, multilaterals, and so on, then that will make it much easier to sell, which means there'll be more of it. It's classic supply and demand, and that can be made a whole lot easier by using the digital tools that we now have in a lot more focused way.
Thank you very much, Sean. That's a good, as Marianne said. I think we'll be making some announcements later half of the year on that matter. Cover, final thoughts, please, and SME focus.
Yeah, I think a couple of points. So SMEs, I think if I go back a few years, especially last year and the year before that, SMEs have two issues with banks. One is the cost of compliance has gone up. So the cost of maintaining clients has now quadrupled or doubled, or depending on the bank. So the SMEs simply don't make the cut. There's not enough money there for the bank to keep this clients. So they've been offboarding clients, saying they're not making enough money. So that's where we are now deploying technologies, and other banks are as well, which can significantly bring down that cost of compliance and that cost of making sure the client is maintained with the proper controls and oversight, without having to go into manual operations and cost. That's one. Second is the risk element. So again, SMEs, you can't lend to SMEs on a balance sheet. You have to develop transactional risk management, where the transaction itself is where the risk is controlled, and not through, because you won't find an SME with a balance sheet that you can lend on its own. So I think that's the other thing we're looking at, and we're going to do, and the industry is looking at, is where the transaction itself provides the risk mitigation rather than the balance sheet. I think these two things, the cost of compliance and through automation, and transaction risk management, is what can unlock the SME market for banks again.
Great. Thank you very much, Cover. Ronit, your thoughts, please.
Sure. Problem with traditional banking, even before COVID, is that it tends to rely on paper and collateral. So if you're an SME, you need to go and get a loan. You often have to put your house or other assets up for collateral, and it requires lots of paperwork. Where we can, whether it's fintechs or digital banks, help is the more we can use data, the more we can use cash flow, real-time solutions, whether it's for solo entrepreneurs or for SMEs, the better we can make our clients' lives. And that's, I think, what everyone's trying to do. That'll A, improve access to credit for SMEs, and B, hopefully also allow banks and fintechs to provide credit at lower risk. So there are a few initiatives in the Middle East, in the GCC. There are obviously quite a few good case studies in the US and India. So I look forward to seeing that happen more in this part of the world.
Great. Thank you very much, Ronit. Paul, any thoughts from the technology perspective specifically, and of course on the SME side, and some of your final thoughts, please?
Yeah, sure. I think all the points that were mentioned are all valid, but I think the main question is how you as a bank can make money, from providing financing to SMEs and to startups, right? So the key point here, because again, historically, banks don't make money from providing loans to SMEs. Banks make money from big loans to big corporates with big margins. And then again, the collateral point, which I think Ronit mentioned, is a very important point. So the question now is, can we rely on new technology like AI, machine learning, advanced data analytics to provide better financing to these SMEs? And I think the catch here is not to look at the transactions per se. So you are a bank, you're financing SMEs, but you want to look at a different business model with these SMEs. You want to partner with these SMEs, so to try to make for the revenue, maybe from somewhere else. Again, we're talking about really low profit here, low profit margin. Unlike corporate loans, when you look at SME loans, it's a different ball game for banks. If it's not lucrative enough for banks, banks are not going to touch it. Banks are going to focus somewhere else, which I guess makes sense. But by using technology today, this is something that may become really lucrative for banks, for fintechs, and also other service providers. So then, again, because everybody is chasing growth.
Great, thank you very much. Marianne, if I may ask you for your final thought. The regulator always has the final thought. Would love to hear your views, please.
Mm-hmm. No, I agree with all that has been said by all the other panel speakers. What I would like to add is that another aspect that we've been hearing lots of discussions about, and which may bring a bit of a change within the SME financing landscape, is the fact that banks have tended to bundle all SMEs as high risk and not really make a distinction between the different types of SMEs and their performance in terms of repayment back of loans. And we're seeing also interest in the establishment of data sharing platforms and credit ratings for SMEs, which can be centralized in a way that can be tapped into by banks or lenders, because you don't necessarily need to be a fully-blown bank, but also you can get a lending license to service the SME market on the funding side. So I think that will also be a crucial development that could, from the fintech side, that could make a difference in the SME lending space, which is a very important aspect because SMEs make a substantial portion of the economy, and it's important that these SMEs are developed and get the right financing and access to services that they require to continue to grow their businesses.
Great. Thank you very much. I think that brings us to the end of the panel. As I said, we have a very august panel with great insights, and you could just see the interplay of various perspectives on digital banking. I think this year is going to be very, very exciting. Quite a lot of interesting initiatives are going to be announced globally and, of course, within ADGM. So, first of all, thank you very much for all the panelists for taking the time to join us. Thank you ever so much for all the various participants who have joined us from so many countries. And look forward to joining you again in our next webinar. Thank you very much and stay safe.
Okay.
Thanks.